Hi, I'm Steve Van Metre. Welcome to your weekly economic update where we take a deeper dive into what's going on in the stock market and the economy and try to make some sense of it all. And again, right now, a lot of things just don't make a lot of sense. Let's start out with Larry Kudlow, the economic advisor to President Trump, said the federal funds rate is too high and the Fed needs to cut the federal funds rate by 0.5%. 3 months ago, greatest economy in the world, greatest economy in the history of the United States. But the greatest economy we've ever seen, which isn't true, can't handle federal funds rate at 2.5%. Doesn't make any sense. Why does it need to go down to 2? Why can't it go up to 3 or 3.5? If the economy is so good, then interest rates need to rise, and they're falling. So why would Kudlow come out and say that? Is it just because he likes lower interest rates? Or is it because something worse is coming that they see coming down the pipe and they don't want to alarm investors? I don't know. It doesn't make a whole lot of sense, especially when we start digging into the data. Banks are still buying bonds. Why? Because they know something bad's coming. And it just really, to me, it just is all very, very interesting. Now, this week in our update, we talked about the 10 to 3 month yield curve. And this is where you take 10-year Treasury yields, subtract the 3-month Treasury yields, which essentially the 3-month would be your risk-free rate, and you get what's called the spread, the difference between the two. Now, in a healthy economy, you would expect that short-term interest rates should be down here, long-term interest rates are up there. It only makes logical sense. Why would I, borrow money at 10 years if it's, or why would I, not why I borrow, not why would I borrow, but why would I, go tie up my money for 10 years when you effectively get the same rate for 3 months? It's a problem in the economy. And for banks, it's even worse, because why is this a problem for banks? Banks always lend at short-term rates. Banks borrow at long-term rates from the Fed, borrow short-term rates, lend out at long-term rates. I'm having a little bit of an off day, so just work with me here for a little bit. And so banks are borrowing at the short-term, lending at the long-term. Well, if the spread is negative, so if they're borrowing at short-term rates and they're lending out at a loss because 10-year yields are below 3-month yields, they don't make any money. So they don't lend. And well, when you're in a debt-based economy, you need a continuous expansion of debt. It needs to continue to grow. And if banks don't lend, you get yourself quickly into a recession. So what's interesting about this, what's called the yield curve, is it is the best predictor of recessions in the history. It has pretty much predicted every recession except gave one false positive when a large hedge fund blew up. And then 2 years later, we had a recession. So it did create one false positive, but it's never been wrong beyond that, not once. And what you'll find is asset prices and other things, such as stock prices, are correlated to this yield curve. And it just tells you something is really functionally wrong in the economy, because long-term yields should be higher than short-term yields. It makes sense. If I go down to the bank and I want to buy a 90-day CD or a 10-year CD, I don't think they exist, but we'll just pretend that they do, I should be paid more interest for tying up my money for 10 years, not less. Again, tells you something very structurally is wrong, and perhaps that's what Kudlow knows. He knows that this is a problem. So I was just about to read the disclosures, but now I kind of want to move on. Why is the Fed not panicked? In fact, Janet Yellen, who is no longer part of the Fed, but still garners a lot of attention, said that they are concerned about this because it's temporary. See, the Fed thinks that the second quarter is going to see the economy shoot back up. And when it shoots back up, guess what's going to go with it normally is interest rates. So normally interest rates should rise, and it would be the long-term rates. And then that would kind of balance the system out. So right now, long-term rates are a little below. And if the economy picked up, they would rise. And so that's what the Fed is expecting. So they kind of pause right now because, well, they don't like the situation, but they think all of this is caused not by the trade war, not by the decelerating money supply, not by their own tightening, but due to the government shutdown in January. Here we are at the end of March, and we're still worried about what happened in January. That's kind of behind us now, and there's no data to suggest that this was a one-off event. This this deceleration in the economy has been going on for a while is simply due to the lags in the economic data and due to the lags in monetary policy, which range from 14 to 18 months. So decisions the Fed made and implemented 14 to 18 months ago are affecting today. They could lower the federal funds rate by 0.5%, won't do much. They can blame it on the government shutdown. It won't matter. But that's what they're doing. And the Fed thinks that in the second quarter, things will get better. Interest rates, long-term rates will rise. The yield curve will stop inverting. Well, I don't think so. But maybe they're right. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that everyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So I'm not going to ask that you believe me. No, I want you to be educated and look at the data and say, does this all make sense? So let's jump back over to the charts and let's look at the first thing. If everything's fine, then we should see a strong growing money supply. What we should really see. And I don't know why. I don't know why this says 19977 because the real number is that. And with the magic of movie editing, we can fix stuff real quick. So let's look at the money supply. It is down to 4.10%. It's slowly sliding back down. Growth rate of the money supply decreased by $9 billion this past, it'd be 2 weeks ago. This is always 1 week behind where we're at. But here's what's interesting. The 6-month rate of change is falling. It's down to 1.77%. But the 3-month rate of change went from roughly 0.9 to 0.46% and is falling. So here's one of the first tests. Do you know the last time the 3-month rate of change in the money supply was 0 or negative, which at the current rate will be at in a couple weeks? 2009. And what was going on in 2009? We were a massive recession, stocks were down a ton, and the Fed was implementing quantitative easing 1. So a lot of these people are saying, hey, this yield curve thing doesn't matter. It can take up to 2 years before we have a recession. Historically true. But what they don't go back and look at is the money supply when the yield curve inverts is running at a much, much higher rate. It really doesn't run this low when you go into an inversion. This tells us something is structurally wrong, and the stock market isn't pricing it in at all. The stock market thinks that everything is great, but the reality is the 3-month rate of change is about to contract. There's no fiscal stimulus. There's no monetary stimulus. There's no stimulus that's going to turn this around. None. It might turn up a little bit, but structure in the broad direction of it, there is nothing coming to change its direction. Let's look at commercial industrial loans. Now you can see this. It looks like it's starting to roll over again. Last week it fell below 10. We didn't have data last week because the charts were not updating. This week we're back up to a 10.6% growth rate versus 2.63% from a year ago. So overall weak growth. I may or may not have mentioned this, but since I have forgotten if I did, I will mention it again. This growth here was mostly due to corporations who normally were borrowing at short-term interest rates have been tapped out of that market and are having to go to long-term rates to get money that they need. So this is a bit of an anomaly, but it looks like it's rolling over, and that is not good. Looking at the consumer, consumers are still charging strongly at a 5.91% year-over-year growth rate on their credit cards. It's strong compared to where it could be, but this is a problem as well. Consumers are not really driving the economy. We could see stock prices bounced off here, but we did not see consumer spending or consumer charging, money supply growth. None of that is really doing anything here. So this is pretty weak as well. And I bet if I went back and looked at prior times when the yield curve inverted, we would see that this was running at a much higher level. Federal Reserve dropped $7 billion off the balance sheet last 2 weeks ago. Again, no sign of the bell of the markets here that everyone talked about. Stock prices are purely running on emotion. They're not running on fundamentals or anything because, well, no one really looks at that anymore. So this is going to continue to fall for a couple more months, and then the Fed's going to back off a little bit. It's going to fall, and then at the end of September, this should kind of look like this once again. Looking at total savings deposits at depository institutions, still very weak despite interest rates at one point being higher and now being lower. Still nothing to attract savings into bank accounts. Not good a sign for the health of the consumer at all. Looking at calendar year growth for earnings, I think before I mentioned this was quarterly. I was wrong. It's calendar year. And you can see as of the end of the year, there was expected to be strong earnings growth pretty much across the board. And as of now, this is only a couple days old. You see industrials, lower growth, discretionary, lower growth, financials, consumer services, utilities, healthcare, the broad S&P, real estate, info, technology, consumer staples, all showing lower growth. Materials, where you get a lot of mining stocks and energy, this would be the oil sector, primarily showing negative growth for the year. And yet people still think the stocks are the place to be when growth rates are slowing. Looking for earnings per share guidance in the first quarter, the number of S&P 500 companies with positive and negative guidance. You can see a lot of negative is the red, and this is not normal. So what you would expect is more green here than red. So this is telling us that of the companies that have posted forward guidance, most of them are posting negative guidance. And again, the stock market isn't pricing any of that in at all. And here's kind of one of the things that I wanted to mention is people think stock prices can just keep going up indefinitely. But when you have a decelerating money supply that's going down, there's less money. So you can't have a decelerating money supply, high stock prices, and high earnings. You can have one, but not all three. So that tells us that earnings cannot be great in the first quarter and probably won't be great in the second quarter. And unless investors are just willing to accept less earnings for the price of a stock, which they generally don't, that means stock prices have to come down. And that is why the money supply matters, because you can't have small money supply growth, right? I can't have a river with a little bit of water running down it and expect to float big ships down it. I can't do it. Maybe I can cram one down there every once in a while, but the reality is I either have to shrink the number of ships or shrink the size of them, or probably both. Same is true with money supply. Can't have high stock prices and high earnings. And generally, weaker earnings leads to lower stock prices. So it would be, and we still haven't seen from this quarter, this quarterly earnings, any of the real big names other than we've seen FedEx and some other companies have some bad outlook. But some of the bigger names that we're looking for haven't yet reported. Looking at the buyback binge, quarterly buybacks have set a fourth consecutive record, hitting $223 billion, and the quarter ended on December 1st. So despite the market falling 20% in the fourth quarter, corporations bought a record amount of stocks back in terms of dollar amount. And that should tell you one important thing. Corporate share buybacks cannot prop up the market, because if it did, then the fourth quarter shouldn't have been down 20%. Shouldn't have happened, at least according to this chart. Looking at the number of shares outstanding, this is a pretty cool chart by Yardeni Research, and they take the total number of shares outstanding versus the S&P 500 divisor, and you can see that the number of S&P 500 shares have been falling. In fact, they're below where they were back in the last recession. And then you say, well, wait a minute. The number of shares outstanding rose. And here's one of the things I have been warning about. Corporations have been stacking up a boatload of debt, the most debt in history, more than they did going into the last recession. Ton of debt. So they've been buying their shares back as quickly as they can so the executives can cash out, quit their jobs, and leave. In fact, this week we saw 3 CEOs of major companies hit the trails. And why would you do that? It's real simple. If I have, let's say my company has granted me, $50 million in stock options, right? Well, they may not have vested yet, but what's one usually sneaky trigger point? If you quit your job, they can vest. So I quit, cash out my stock. I call up, my broker, who is going to be conveniently at the same company I'm directing my share buybacks from my corporation through, and say, hey, I'm going to be out of here pretty soon. So when I quit, I want you to sell all my stocks as my former company continues to buy, because I just made an executive order for them to buy, $200 million worth of stock back, and I want mine out. So what happens is the number of shares outstanding fall. But after recessions, to pay for all of the debt that these corporations accumulated, because obviously earnings fall during recessions, profits fall or contract during recessions. So how do companies pay all the debt? Well, one, they lay off people. That's a no-brainer. But one of the most important things to corporations are their credit rating. They will sacrifice a lot of things to keep their credit rating up. So what do? Well, very simple. You issue more shares. And that's what causes stock prices to stay depressed. So you can look, the market started to bottom back here, but in 2009, kind of somewhere around in between the first and second quarter. And then finally, the number of shares being dumped onto the market peaked by 2010. And so it took a while for the market to absorb all of these shares. And now, look, we have less than we did in 2008. So wait till everybody starts to have to sell. When the market goes down, they're going to find what I've been saying, there are no buyers. This is an interesting chart posted by Chai Girl. She's from Chicago, is the Chai. She's on Twitter at Chai Girl. And she was charting gold. And one of the things I noticed was gold was in this kind of rising channel. We've looked at this potential left shoulder, right shoulder, or left shoulder, head, right shoulder. And when you see this kind of rising channel like this, it's generally means prices are headed lower. So it'll break out of the channel, pop up, and head down. And I put this on here because I kind of really agree with that view. And what happened, we'll look at gold. It actually did that. We looked at this chart, I want to say on Wednesday. The net speculative position in bond futures is still deeply negative. So anyone that thinks that bonds are a bad thing to own are wrong, because there's a lot of short interest. And eventually all of those shorts have historically get pushed into long position. This is where you sell when you're in that. When you own these, you sell up here after all these short sellers become buyers when they get squeezed out. And they are being squeezed out by the banks. And I think this is the last chart. I'm not sure, but I think it is. Position is super short in the VIX, a worrisome signal of too uniform market thinking. I mean, everybody is back shorting volatility. They did this in 2018. Volatility exploded. They didn't learn their lesson. So investors learned nothing. They went back and shorted volatility, bought stocks, and at some point this will explode again, causing a violent unwind in the market. Oh, and this is this is the last slide. This is from a book written by Ludwig von Mises. He is the father of Austrian economics. The causes of the economic crisis is written in his book back in 1931. The sooner the credit expansion policy is brought to a stop, which is what we're in, a credit expansion policy, the less harm will have been done by the misdirection of entrepreneurial activity. The milder the crisis and the shorter the following period of economic stagnation and general depression. So he's referring to the Great Depression was a massive expansion of credit. It was. The appearance of periodically recurring economic crises is the necessary consequence of repeatedly renewed attempts to reduce the natural rates of interest. Sound familiar? The Fed's been reducing the natural rate of interest on the market by means of banking policy, hence the Fed. The crises will never disappear so long as men have not learned to avoid such pump priming, because an artificially stimulated boom must inevitably lead to a crisis and depression. Let's go over that again. Because an artificially stimulated boom, which is what we did, must inevitably lead to crisis and depression. The crisis from which we are now suffering is also the outcome of a credit expansion. You could almost reword this for today. The present crisis is the unavoidable sequel to a boom. Such a crisis necessarily follows every boom generated by the attempt to reduce the natural rate of interest through increasing the fiduciary media, aka the money supply. And just as I have said, we are headed for at least a recession, if not the worst depression that will be in the lifetime of anyone watching this video. Or to watch this video in the near term future. All right, let's switch over to the web browser. And this is from Zero Hedge. This is they kind of post a daily market brief full of not a lot of text, but a lot of graphs, which is pretty cool. And I've been saying that this disconnect between stock prices and bond yields is an issue. And so they conveniently posted one. I thought we'd look at it. Global stock and global bond yields have decoupled dramatically in quarter one, which they have. So this is the MSCI World Index, Stock Index, and the Bloomberg Barclays Global Government Bond Index. And you can see there's a big gap. And they're kind of pointing out, hey, look, the last time this happened back in 2007, well, stock prices are the one that get reconnected with Treasury yields. It's very rare that you see yields, in this case right here, back in 2008 rise. It's usually you see stock prices fall to catch up with yields. So I thought that was pretty interesting. Let's take a look at the Fed and the H.8 report. Let's see what banks are up to. And the Treasury and agency securities, they bought $8 billion worth of mortgage-backed securities in the week ending March 20th. Not mortgage-backed, U.S. Treasury bonds. They bought, looks like $3 billion of mortgage-backed securities and $5 billion of other bonds. You notice they are buying. And that's important. When the banks buy bonds, well, you should consider why they're doing it. They know more than anything else. Let's look at the macro view of the climate. So we've got some warmer temperatures coming. And if you look at the 6 to 10 day report, there's more rain, above average rain, coming from the place of the country that's flooded. If we go out 8 to 14 days and we see more warm weather, which I'm sure the farmers out there will be happy to maybe dry up some of all that water, but there's still going to be a slightly above average precipitation, and you can see potentially an even bigger storm coming. As NOAA has said, there is more flooding in the months to come for this region. And according to, I think the Nebraska governor, this is the worst. I just don't remember if it was the governor or someone else. This is the worst flooding in the history of the state. It's only going to get worse. And he was asked in an interview, the media hasn't drawn any attention to this. He's like, yeah, I know, and I don't know why. He wasn't sure. Pretty interesting. All right, this is the yield curve that I want. And you can go to the Fed database, St. Louis Fed, and all you have to do is type in. I go into the search engine here. You can see exactly what I type: Fred 10Y3 space 3M, and you'll get this. And this is a historical chart, and you can see that usually somewhere around 18 to 24 months before you get an inversion of the yield curve. Nobody seems to panic, except now we're at this very low point. And what does this mean for asset prices? Well, let's just see if this will work. I know we've tried this a couple times, and it doesn't always work. Let's see. Oops. Let's look at the Wilshire 5000. This isn't meant to encompass the entire U.S. stock market. Let's overlay this. And you can see when the yield curve starts to invert, it's negative for asset prices. At some point here, you see the yield curve rising. So what does it mean when you see the yield curve rising after an inversion? It's because the Fed waited too long to see if the economy would pick back up steam and long-term rates would rise, so they're forced to lower short-term rates. One of the reasons you're hearing people saying, such as myself, the Fed's headed back to zero, possibly by the end of this year, is because long-term rates aren't going to rise. It's not going to happen. So how do you fix the inversion? You go down to the zero band, which everyone thinks must be bullish for stock prices, and it's not. It usually means something is structurally wrong, and then you get a big dump. Let's see. For fun, let's go and put 10-year Treasury yields, which should tell us the same story, because part of this is 10-year Treasury yields, but we'll go on here and do this. So just so you can see, there's nothing really fancy I'm doing. I'm not even logged into my account where I have some of these charts saved, but I thought it's fun to do it live so you can see, if you want to make your own chart or take a look at this later, it's pretty easy to do. And you can see that going into inversions, I'm going to keep my mouse down here, that generally going into inversions, it's bearish for yields. You can see here, 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 and that tells us that yields are headed lower once again. Let's take a look at oil. Oil is a proxy for economic growth and inflation. So we can go here and type in WTI, and we'll get the West Texas Intermediate, for those of you wondering what WTI stands for. And there you go. Now, isn't this interesting? Look at how well oil tracks this yield curve starting back right in here. I mean, it doesn't shoot straight up back in the early 2000s, but it certainly rises as the yield curve rises, and then the yield curve falls. It starts to stumble right in there, rises as the yield curve rise, recession is obviously going to crash oil prices. Then it picks back up with the yield curve, and you can see it's following it really tightly here, except right here at the end. And we'll zoom in a little bit. And so you can see that oil prices, based on the yield curve, are headed below their December lows. Pretty interesting, right? So you can see this is headed lower, and the yield curve is obviously extremely interesting because it does tell us bad things are coming. All right, let's take a look at the charts and see if they reveal anything interesting to us. And I see I've been talking for 25 minutes, and I wasn't planning on that. I do like to keep these to around 30 minutes, so let's just move quickly. S&P 500 finally got out of this top of this resistance band. Will it hold, or will it make one final run up to making this right shoulder matching up here at 28.75 or thereabouts? We'll see. Taking a look at 10-year Treasury yields, a little bump today, or last 3 days, a little move higher. With banks buying, this is not going to continue going up. It's going to reverse direction. And we can see based on this red candlestick that yields went up but traded lower. Same with 30-year yields. They actually dropped more than the 10-year. So there's a problem. When you see longer-term yields falling faster than shorter term, it's a problem. And then 5-year yields, which are a proxy for oil prices, are telling us that oil prices are headed lower than they were back in December of 2018. Let's take a look at physical gold. A lot of interest here. It broke down below this support level here, and then it checked in. So it broke support, came back in, verified. Nope, not going to hold this. It tells us the next move for gold, that it will probably try to stop somewhere in the middle here around 1270 to 1275, but its major destination is down here around 1240 to 1250. I think this is where it likely stops, because when you start to get a long trending move up, prices will rally. They'll pull back around anywhere from half to 2/3 of the first move, and then they'll go from there. And if it sticks and holds up here, it gives gold a running chance at breaking through this 1240 level to 1250, which has been a problem. Get through 1380, and this thing is go, because you've got a lot of consolidation in here. So I'm thinking 1250 is where it goes. We'll see. Taking a look at the gold miners, and what you see here is they're following suit, headed lower. So the gold miners, I'm thinking, are going to come down around this $20.25. Silver is telling us they broke through their 50-day moving average and are headed down as well. Silver seems to be a better proxy for what the gold miners are going to do. I suspect they'll be down to this $24 price range. Looking at oil and gas producers, are stuck in the sideways channel. Tried to break out today in early trading and close right above their 100-day moving average, but these sideways patterns are generally bearish. They're generally a continuation of the downward move. So we'll see kind of where that ends up. Looking at Treasury bonds, this is a 7 to 10 year. You can see it. Let me zoom out a little more. I know I'm going quick, but I want to finish this right around the 30-minute mark. So I could have drawn this dashed line as a channel. I didn't. So it kind of broke over this kind of channel that's going right along here. You can kind of look at, it could be a little higher, could be a little lower, but it's kind of just roughly the middle of the channel. It's broken over here. It's confirming support on this channel. Says that 7 to 10 year Treasury bonds are headed up into resistance here. And then from there, if they get out of this, now you've got a real shot back at their all-time highs. Looking at the long bond, the 20-plus Treasury yields, the same situation here. They're just confirming with this little support level here. Here's the major resistance. From there, you've got a big move higher and some gaps to fill to take this potentially back near or to its all-time highs. And last but not least, let's look at the ags. I was hoping this was going to stick and stay right here. Normally when you get these moves, again, you get a move up, a pullback, and there's a lot of volume here. So a lot of people come in and selling, and somewhere, again, half to 2/3 of the way down, it holds, and then you get the next leg up. And that's kind of what would expect here, especially when the news about what's going on in the farming region really starts to hit the wire. People are going to be surprised how much crop inventory is damaged. And, really the situation for farmers is just because the water recedes doesn't mean they've got their tractor sitting there idled, ready to roll. I mean, their houses have been flooded or washed away. I mean, their equipment is flooded. Their storage containers are flooded and broken. I mean, they've got a lot of stuff, and you can't plant in mud. I mean, they need ideal planting conditions. They don't have it. So if you look at productivity and what's going on in this area, it's not good. And if you look at the solar minimums, let me switch over. We should look at this real quick. And there you go. No sunspots. I mean, there's just none. So this bizarre weather that we're seeing isn't going away. Well, I'm Steve Van Metre. This is your weekly economic update. We'll be back with you Monday for a 15-minute snapshot of, what's happening on Monday and maybe if there's anything over the weekend. If you have any questions, give me a call. Send me an email. Here for you. Bye now.